Hello and welcome to the latest edition of our LexisNexis Risk Solutions Facing Change series. I'm Luke Davis, and today I'm delighted to be joined by Martin Bird, Senior Partner and Head of Risk Settlement at Aon. So Martin, we've seen a significant increase in transaction volumes in the pension sector in recent years. How do you think the current social and economic situation will affect the de-risking market now?
I think it's been something of a rollercoaster year so far. I mean, we came out of 2019, with an absolute bumper settlement market, at over 40 billion of transactions. So it was a reflection of a huge amount of momentum in the risk transfer space. A lot of focus on corporates and trustees wanting to de-risk their pension arrangements. That momentum carried into 2020, but obviously COVID kind of hitting in March created a lot of disruption again. I think that was a real mixed bag. We had a number of projects that paused, either because pressing priorities elsewhere, or actually just taking stock of funding positions, taking stock of pressure on investment portfolios, liquidity and collateral issues caused a lot of risk transfer projects just to time out. Equally, we saw quite a few projects accelerate as well because the volatility actually created opportunities. I think, again, kind of 6 months on, net, I feel like there's more activity than perhaps we were anticipating back in March. Huge amount of opportunity coming out of the volatility.
You'd say you're in the camp that there won't be some stalemate or hold off from UK pension schemes. Rather, the volatility may actually spur things forward. Do you think that's a fair summary from what you're seeing so far?
So, some of this clearly interacts with individual scheme circumstances and funding positions, and to the extent that schemes, particularly those schemes that have still got significant exposure to the stock markets, that they may be grappling with larger deficits to repair. Having said that, many schemes are very well hedged, and actually the volatility in markets has created opportunity, and specifically volatility in credit markets. So credit spreads widening considerably has created a lot of opportunity in the bulk annuity market.
If we turn to mortality rates, longevity, for example, in your view, how has COVID-19 been impacting mortality rates and longer term expectations around longevity?
I think it's fair to say that the impact of COVID-19, we're kind of still in a wait to see mode on it. I mean, I think generally the consensus across the market at the moment is very mindful of the kind of sensitivity when we're talking about loss of human life. But the reality of the numbers at the moment haven't really changed the market's view on long-term outlook for longevity. I think there'll be a huge debate as we get to the end of the year about how we capture 2020 experience. Is it kind of a one-off year, and we should place less weight on it than we might ordinarily do, or how do we roll that into the general forecasts? Consequently, I don't think the pension, the insurance, or the reinsurance market has particularly moved their outlook just yet.
If we just take a step back, looking at the bigger picture, what's your view on how schemes can keep on top of emerging trends in a fast-moving world which we find ourselves in?
I think schemes that are looking not just at risk management and risk transfer solutions, but generally looking at monitoring funding levels, are doing things in a much more real-time fashion these days. So whether that's kind of daily, monthly reviews of funding positions, and specifically on the topic of mortality, very regular monitoring of actual scheme experience. We're kind of probably moving away from an industry that looked at valuation experience in relation to deaths on a 3 yearly basis, and doing it much more frequently. And certainly when we're thinking about affordability of risk transfer, having a good handle on how your own population is behaving, and very up-to-date, clean, accurate data it is really, really important.
And can I just bring you back to the risk settlement deals kind of viewpoint for a moment? How important is sanction screening becoming in that environment?
We talk about data and keeping up to date with death processes, but just as important is things like our members, have they been suspended? Big topic. Are they on the sanctions list? Big topic. Insurance, reinsurance community very aware of their obligations to make sure that they're not paying payments in respect of people on the sanctions list. I think that's proven a bit of a challenge for pension schemes, figuring out how they actually do that. I think it's crystallised in the context of a settlement transaction where there's a contractual obligation to do that. I think historically that was something that the insurance market and the reinsurance market took the responsibility to do all of those checks. But increasingly, we are seeing a very strong, rapid trend to the requirement to do that being passed directly to the pension scheme, and pension schemes thinking about whether or not their regular monthly process is set up to do that.
We were interested to recently see the pension regulator's guidance on DB super funds, which have been published last month. How do you think this alters the landscape for pension schemes that are looking to de-risk and utilise the sorts of model you've talked about there, Martin?
I mean, at the end of the day, it's more choice, and schemes looking to de-risk. The greater the variety of choice out there, to a large degree, the better that is. I think obviously the consolidation model is still early days. We haven't actually seen any schemes transact yet. Very helpful that the regulator has issued some guidance on that. I think that's been long awaited and probably long needed to give some confidence to trustees around what the expectations are in that marketplace. I mean, we're positive about it in the sense that, for a number of schemes, the reality is that insurance solutions are out of reach. And potentially there's a segment in the market where trustees have genuine concerns about sponsor covenant.
Are there any closing remarks, Martin, you'd share with all of us in terms of just how schemes can take pragmatic steps to make sure they're primed, ready to seize opportunities from this volatility in market?
I think the key point really is going back to this theme of preparation, and that's all the nitty gritty bits of preparation that we talked. But also, I think the final piece I'd add to the jigsaw is really strong governance preparation. So actually understanding how you make decisions and how you kind of work with different stakeholders and get principles agreed, so that actually when it comes to making a final decision, you've already got a really strong governance framework to fall back on.